I'm not good with numbers.
Hello there, everyone. Welcome to our, are you ready to retire, downsize, relocate out of California? So lots of our clients, and we are all from different industries where everyone asks the questions that we're going to talk about tonight. So I am Lisa Doyle. I'm a neighborhood, basically a Northern California real estate agent and located here in Danville.
Hi guys, I'm Martin.Johnson. I'm a wealth manager and financial planner here in the East Bay with clients all over the country.
And I'm Pasqua. I'm a CPA. I'm located up in North Bay.
Hi guys, I'm Darrell Nelson with Diversified Capital Funding, and I've been in the business 30 years as a mortgage consultant, and I'm located in Danville as well.
We lost Rick.
Come on back, Rick.
Rick, you're on
You're
mute.
muted there, Rick.
Sorry, I'm trying to be polite. All right. Hi, my name is Rick San Vicente. I'm with the Mutual of Omaha, and I specialize in the lifestyle loan and some of the jumbos that we're going to be talking about today. And I've been doing that for about 15 years.
Nice. Well, and the reason why we all came together, and we welcome you all to our webinar, the reason why we all came together is all of us in our respective industries, we get questions from clients all the time about the idea of retirement, the idea of downsizing. If you are contemplating a move out of California, which a lot of people do, we all love California, but it is a hard place to retire for many of people. They look at other parts of the country where they could take their money that they've gained from all their crazy rises in values here in our California with their home sale and all their investments too with Martin and everyone. And they look at other parts of the country. So what we're going to do is we're just going to highlight some of the things that people ask us in our individual industries. And for me personally, being in real estate, I think the number one question that I get from a lot of people is, we really want to prepare for retirement, whether it's soon or in the next few years. People want to downsize, maybe relocate to other parts of the country, but they don't know where to go. Some of the biggest questions I get is, again, where do I go? Where do I consider? So we're going to highlight two cities today, or two states that a lot of my clients are gravitating towards for lots of reasons, which we'll talk about. And then I get questions from people too is, how do you prepare your home to maximize top dollar? What are the things that you can do? And can you sell a house as is? And all those questions you guys are so welcome to ask. And I'm happy to help you. But we're going to dig down on a couple of areas that I get most questions about. One is Idaho. It seems like 50% of the people I talk to this last couple of years, when I ask them if they're, where they're contemplating a move to, there's a little town called Eagle that everyone loves. It's very similar to Danville from what I understand. Super charming little town, maybe similar to what Danville was maybe 60 years ago. So a little smaller town. And then lots of questions about other, but another one that we get a lot of questions, Dallas, Texas, and the surrounding area. But other areas where people do question me a lot, which on the screen here is Nevada. A lot of the states that don't have state taxes, which we'll talk about the pros and cons of that, but Nevada, Washington, all parts of Arizona, again, parts of Texas, Tennessee, and Florida are some of the top states that I get the most questions about. So we're going to dig down on the two for tonight. And then of course, if you guys have questions for your personal other places, just let me know. So let's talk first about Idaho. Eagle, again, is an area. Right now I have 3 clients moving to Eagle, and I know Darrell has had some clients recently too, relocating there. So a lot of us get questions. Eagle is a smaller town just outside Boise. So it's Boise and the surrounding area. Lots of people intrigued about for various reasons, which we'll kind of go over and discuss the pros there. So you can change the slide, Ms. Francesca. Thank you. So that Eagle area, you can go back to that last slide if you would. That Eagle area is comprised of kind of like the East Bay, where we have, Danville, San Ramon, Dublin, Pleasanton, all the surrounding cities that people love, Walnut Creek and Clayton and that. The Boise, the little cities surrounding there are Meridian, Eagle, Star, Kuna, Nampa, Colwell, and Middleton. And they all have their pluses depending on price range and proximity to Boise. All of them have price brackets that are super affordable as compared to our, Northern California. So people are intrigued by that, although they have had a big bump in demand. A lot of people coming from our area moving there, which are driving prices up. It's still so much more than where we are. So you can go next slide. Thanks, Francesca. So a lot of people, what has been driving a lot of people that I've talked to that area is Idaho is, at least this part of Idaho, a lot of people confuse Boise with the Coeur d'Alene area, which Coeur d'Alene gets a lot more snow. Boise is what I understand in that Eagle area, a lot less snow, similar to what you might see in the Reno area. It's colder, but a lot of clear skies and colder weather, 4 seasons. People tend to love that. Tons of outdoor activities. You know, here in Northern California, we have so many people that are very into cycling and, you know, bowling and all the things that we love about our beautiful area here, you know, the proximity to skiing, which of course this area offers as well. There's a ton of culture, much more than what most people realize. You know, all the research that I've done about this area, a lot of Danville, San Ramon, North, you know, East Bay, people have moved there, and a lot of friends of ours that we know there. And then of course, affordable living, which we'll talk about that. And it's a little bit slower pace from what I've heard too, kind of like where we were, like I said, about 60 years ago. So what people have loved about this area, about 220 days of sun, which I think a lot of people are intrigued by. Whenever anyone looks at moving out of California, the biggest challenge is, what about the weather? It rains too much, it's too hot, it's too much hurricane, you know, things like that. So this area tends to be much more clear, a little bit colder, and you do get some snow. But they do have wonderful 4 seasons, lots of bake. And what I've learned about this area, am I still okay with my guys, the audio? What I've heard people love about this area is, unlike our, you know, in our Danville area, we have a lot of open spaces where there's a lot of greenery. In this area, you get a lot more open spaces that are water, so lakes and man-made lakes and ponds and lots of water. So it's real pretty. Next slide, Ms. Francesca. Thank you so much. And so this is a super fun fact for those of us that love wine and Napa and all the things that we get to do with wine tasting. Idaho people, it looks as though they are some of the highest per capita enjoyers of wine. So something to keep in mind if you enjoy your wine. All of us love to go to Napa and go to livermore and wine taste. You have that in that area as well. Lots of industry there. So as far as outdoor activities, what I've discovered with all the research that I've done in that area is there's about 24 golf courses just surrounding Boise. So a lot of outdoor, you know, everyone from Blackhawk and Alamo and all the places where they love the golf, lots of rivers, lots of hiking, camping, you know, fishing, just, you know, the outdoor activities has been a big draw for most of our, you know, the people that move from our area, lots of trails for cycling. So just an endless outdoor adventures. And now we'll get into a little bit about pricing. And this again talks about the culture that we had before. Lots of museum, which a lot of people say to me that they love the Northern California because we do have San Francisco and a lot of places you can go for the arts, you know, dance and ballet and the museums. Well, this area has the same availability. So hospitals and airport, I get a lot of questions from families that are retiring. You know, of course, they need to have both of these close by so they can visit their family more easily. And then also hospitals. So there's 3 major hospital facilities right in that greater Boise. So super close, easy to get to, you know, not a lot of traffic to those areas. And then same with the airport. You know, you're looking at about a 40-minute or 30-minute drive or less to get to the airport from that area. So it's pretty convenient. So as far as the home pricing, this is where a lot of people have been attracted. Idaho does not have a state tax. So of course the taxes are low. And one of the advantages of this area too is their real estate taxes are quite low. They are less than our area percentage wise. Average sales prices in the Boise area around $625,000. So you can actually buy a nice retirement home in a 55 and older community for under that. Although you do have some areas where they're more as well, which we'll talk about that as well. But you know, 400 to 600,000 in the main parts of that Eagle and Meridian areas. So Eagle's the most expensive. Eagle's kind of like Danville, Blackhawk of our East Bay, you know, the La Miranda area, same thing. So you can buy a very nice new home, new construction, 4,300 square feet, 1.5 or less. But the average price in Eagle itself is about $1,050,000, $1,055,000. So still significantly more affordable than here. And this gives you a couple of examples. So Star is a little community outside of Eagle. You can get the average house, 2,800 square feet, nice 3-bedroom, single story. And lots of them have those little RV garages. You know, a lot of people end up hitting the road with their RVs and spending time on the camping, but under $1 million, 30-acre lot, newer home. And then the average sales price in Star is as low as the 600s. So you can still get a nice home, even in the Star area in a popular 55 and older for less than, you know, 700,000-800,000. Which we're going to talk about. You can sell your $2.5-3 million home here in Northern California, move to that area, and then talk to Martin about investing some of the extra. So we'll talk about that. Sales prices, if you were to look at Boise downtown, which everybody loves to talk about, like, what do I want to do if I want to live in the more urban area? So less than $1 million, a newer condo townhouse walking to town, downtown Boise, less than $1 million. So still pretty good. And then 55 and older communities, here's a few examples of homes that have sold. So you've got, you know, single story, just under 1,700 square feet selling for just over 500,000. And these are properties that just recently sold. So it's a good example of what's possible. And then we've got a few of our other areas and cities that we'll talk about. Meridian. Again, Meridian, one of the even more affordable, under 400,000 for a nice 2-bedroom, 2-bath, single story. So lots of retirees can go there on a pretty low budget and enjoy right next to golf courses and beautiful, lakes and ponds, and it's just lovely. And then here's some example Meridian, same thing, under 700,000. These are townhomes, but they're single story, so very designed well for retirees or, you know, over 55s. And then Nampa is the last few of the areas, a little bit farther out from the Boise area, but pricing even more affordable. I have a client right now that just moved to Nampa, and they paid under 400,000 for a nice single story house. And they just paid cash for it. So it's a pretty, nice area. And then here, if anyone has any questions about that greater Boise area, I have some realtor friends there that are wonderful, Doug and Joan Johnson, and here's their contact. They've lived in that area for 25 years. They actually originally were from the Danville area, and they moved there years ago, started their practice over, and have built a life. So they have some good information they can offer. And then lastly, we're going to talk a little bit more about the Texas area. So lots of people asking questions about Dallas and the surrounding area is the second place I get most of the questions about. This area is actually a little bit more affordable pricing, but their real estate taxes are quite a bit higher, which Darrell's going to go into that in a little bit here. So Dallas and the surrounding, we'll go through a couple of the cities here and some of the pluses. So Dallas, one of the things that people love about that area is still a lot of culture, a lot of sporting events, of course, as all of us that are football fans and all that. But there's, a lot of, museums and art and, dance and ballet and things there as well. Lots of businesses have moved to this area, so there's a lot of growth there as far as jobs. You can change the slide, Missy. Thank you. So here's a little bit about Dallas. Dallas is actually quite big population. They're over 1.4 million. It's a pretty broad area, but pricing is still, you can buy a house in the median price of $200,000 to $300,000. So cost of living, they're ranked in one of the highest areas as far as low cost of living and some of the best places to retire in 2020. So this is a place that a lot of business, like I said, a lot of businesses are gravitating. I know 2 companies that have moved their main headquarters to Dallas. And here's a little bit more about the retirement possibilities. Medium home price is $284,000, which is super affordable. There's, and one of the things that I love about both of the areas that we've talked about is a lot of our clients that have moved to these areas, the adult parents move to retire and the adult children with the grandchildren have followed them. So there's colleges, there's great schools in the area, universities close by. So it's been an attraction for a lot of the younger families to follow their parents as well, just because of the affordability. And then we've got a little bit more about the other cities in that area. So Frisco, average sales price, $300,000 for about a 3,000 square foot home. So super affordable, 55 and older, lots of developments there in all of the cities surrounding Dallas, and lots of water feature there as well. Flower Mound, another area where you can get a super, pretty large array of retirement communities, and prices are super affordable. The only thing that people have tended to share about these areas is it does get a little hotter. So you've got, you know, a little bit more heat, but nice pools and, you know, air conditioning, keep you cool. Rockwall, Texas, low 300s. Same with Del Webb, the communities there in Little Elm, you know, 300s to 600s. And then Salina is probably one of the most affordable, as low as about the 200,000 still. You can still purchase a nice retirement community there for about 200,000. And then you've got a few more: Plano, Flower Mound, just a lot of area. And you can see from the photograph on the Plano property, you know, these are new construction. This house was built last year, selling in the mid to two to 300,000. So a wide of affordability there. And you can switch slides, Francesca. Thank you so much. And then there's a little bit about, I'm going to forward you guys the slides. Anyone who has registered will forward you guys out the slides so you can take a little bit more, you know, some detailed look at some of the cities here. And there's some information on each of the cities. We'll go ahead and forward through. You can change slides, Francesca. Thanks, Madeir. Yep, and then you've got information about each of the cities we just discussed. I'll go ahead and let you slide through those slides. And of course, you know, Frisco is where the Cowboys are, so all of us love to watch that. Although I'm a Niner fan, so we'll root for Niners, but you know, football's good. McKinney is another area where lots of retirees have gone to. And you can switch slides, Francesca. Thank you. Salina is one of those areas I mentioned. One of the things about Salina too is Salina has the highest population of the 60s and older. And I think probably because of the affordability. So the majority of the families that are moving to that area looking there for retirement. And then Allen, Texas is another one. Super famous for retirement areas. This Allen's a little bit more of a draw for the young families too, because the schools here are quite good. So the school district in this area is known for being exceptional. And then I have some dear friends, the McCoys, Terry and Ron, that are real estate brokers there. They are happy to help. We'll make sure we post their information. And of course, if you guys at the end of our presentation, if you have questions, we can answer about any of the other cities as well. But like I said, two of the areas I get the most questions is the Dallas and surrounding, and then Idaho and the Eagle surrounding. So now I'm going to turn it over to Martin, and he's going to talk to you about how do you prepare to invest enough so that you can go and retire with all the money in your pocket.
Well, thanks much, Lisa. That was a really great overview. I really like that. Some really wonderful places to consider for retirement if you're going to move out of state. I wouldn't mind living in one of those nice houses myself, especially I like the Idaho. Some of those Idaho places were really nice. Yeah,
I think Idaho's beautiful. We're going actually just to visit there because we have family in that area, just to see, you know, visit them and see what it's like. But it's supposed to be very pretty.
Yeah, might be a little cooler than Dallas. I don't do well in the heat, so maybe Idaho for me. We'll see.
Yeah.
But yeah, I'm Martin.Johnson. I'm a financial planner, wealth manager here in the East Bay, but I do have clients all over the country. And you know, making this kind of decision, making this kind of move is a big deal for most people. And I'm here to talk about how we can actually run the numbers so you can make an informed decision about this. My contribution today will be looking into the financial analysis, discussing how your cash flow might actually play out should you stay in California versus how things might look if you make a move out of state, and how we can find the resources actually to make all the numbers work. So when my clients look at this type of decision to move out of California, they mostly represent two types of people with two things that tend to drive the decision. The first type are really people looking to make a strategic move, mainly for the tax reasons. The idea here is that you're going to make the move, make a change in tax residence prior to triggering some type of liquidity event or tax event. And typically those are things like, say you have a large 401k. So you make a clean move out of state before you start taking your distributions out. Or you could be starting the payouts from your pension, getting your pension benefits triggered. Or it could be the exercise of some stock option grants that you've been sitting on for a long time, and you have control over that, that exercise. Or it might be the sale of a business, or commercial real estate or rental property, or any other type of spike in your earned income, or some type of decision where you can control the timing of it. If you are considering to make that type of strategic move in advance of one of these events, my strong advice is to be very careful and listen to your our next speaker, Chris, because the state of California is very, very aggressive and does not like missing out on you paying them taxes. So this is something to tread very carefully when you do this, and make sure you do make a clean break with California, which Chris will talk about. More often though, a lot of times it comes down to a realistic type of move, where moving out of California might really be the only way to make the economics work for you, to make these numbers work for your retirement income. And this second type of person, frankly, the move out of California might be the only way to really retire in comfort and the kind of lifestyle that you want to experience. You need to move out to lower your ongoing overall cost of living, taxes being part of it, but all the other costs of living tend to be less in other states than California. And it could be the only way, frankly, to find the needed additional resources, to kind of find that extra chunk of cash needed we need to actually generate income and meet the cash flow needs. And Darrell and Rick will talk about ways we might be able to unlock funds inside your house by making this type of move. And frankly, you just might want less stress. A lot of people don't like the traffic, the crowds, the cost. It's time to make a change. There's a lot of emotional things that go into the decision. They want a less stressful lifestyle. We have a lot of smoke, air pollution, homelessness, droughts, politics here in California. A lot of us are getting a little tired of it. So, a typical plan would be, finding a way to release the home equity locked in your home, and using that to generate income to backfill the missing income in your retirement cash flow needs. Take into consideration things like Social Security, pension, 401k, IRA distributions, that sort of thing. Next slide, please. To do that, we need to answer some questions. How much income can I take out on a sustainable basis? And what is the best way for me and my spouse to claim our Social Security benefits? What are our core and discretionary expenses? And frankly, what's the likelihood, the probability of my money lasting as long as I do? Now, we have some very powerful software, and we can build models and plans to showing all the moving parts to calculate the probability of running out of money in retirement, to show what we can do to show how we can make a plan and how we can make that income sustainable. Next slide, please. The joke was, when we were young, probably living paycheck to paycheck, that you might end up with too much month at the end of the money. Well, when you're in retirement, you really don't want to have too many years left in retirement when you're at the end of your money. That's why we should put a plan in place to avoid that kind of pain in your later years. Next slide, please. Our planning process develops a cash flow model to show where you are now and how to get to the right position to meet your goals. And I'm happy to start a discussion with you to get a real plan in place for this next phase in life. But now I'd like to hand it over to our resident CPA, Chris Pasqua, who will talk about some of the very important tax implications and things you need to be carefully think about when you're considering making this kind of move. Chris?
Well, thank you, Martin. And my name is Chris Pasqua. I'm a CPA, and I've been helping individuals and business owners with their tax compliance and consulting needs for over 20 years now. And today I want to focus primarily on income taxes, which is, generally a big line item on the cash flow models that Martin was just talking about. And so, he and I kind of make a complete person in that, figuring out, whether or not you have enough, means to live off of and get through retirement. But I don't just want to focus on income taxes today, because there's a lot of other taxes that you should consider in your decision process of whether or not to leave California. And so, with that said, it's a very complex topic that I'm going to be talking about today, but I only have a few minutes. So, what works best for you will depend on your particular facts and circumstances. And there's really no one shoe that fits all solution, So today I just want to kind of give you some basic information that you can then use to start a conversation with professionals such as our panel here today, and see how that can apply to your particular situation. So just note, though, that the information I'm going to provide here today can't be relied upon as tax advice. Now, the key here is to seek the advice of a professional before you make any decisions, especially one as life-altering and disruptive as moving to another state. So with all that out of the way, I had to do my legal. Just taxes are just the one constant in our life. And it's why I chose it as a profession. There's income taxes, there's property taxes, there's sales and use taxes, excise taxes, estate taxes. And now many states are trying to adopt a wealth tax. California tried to adopt that a few years ago and failed miserably, thankfully. So the key here is that every state has a different set of rules when it comes to taxes. And so that's why I bring it all up, because you really do want to take a holistic, big picture approach when choosing which state you want to move to. So with that said, now, as you know, California is a high income tax state, and there's no shocker there. But it's actually not that bad when you consider it in terms of other states related to property taxes and sales taxes. Next slide, please. And so in this slide here, in purple are the states in the US that have no income tax. There's 9. And Washington and Texas and Alaska, Florida, among the others being in that mix. But one thing to keep in mind, though, is that in general, states that don't have an income tax generally have a higher property tax and sales tax burden. They've got to balance their budgets somehow. So, you can't have a situation where if you have a relatively low income and therefore relatively low income taxes, moving to a no income tax state, probably won't generate that much of a difference for you on the income tax side of things. But it could very well create a much higher property tax and or sales tax burden. So you might actually come out, worse off. So that's just something to keep in mind. Next slide, please. And to that point, there are, a way, when you look overall, at a macro level in the US between all the different state and local taxes I just mentioned earlier, the states here in green are actually the top 10 states that have the highest overall state and local tax burden on low income folks. And you'll notice here, Washington and Texas are on this list. So again, you really need to look at the numbers before making a decision. Next slide, please. So one thing to keep in mind is that just simply leaving California doesn't mean necessarily that you're going to avoid paying California income taxes. California likes to think that everything is California source income and therefore is taxable in California. So to alleviate that problem is you really truly need to make a clean break, as Martin was mentioning earlier. Because if you don't, you could find yourself in a situation where your income is actually double taxed at the state level. And granted, that's a worst of the worst case scenario, but it could actually happen. And that would be bad. So, to truly cut ties with California for tax purposes, it requires deliberate steps on your part and much pre-planning, and not post-planning, but pre-planning. So you want to definitely seek the advice of a professional before you take any action. So now, what are some of the major considerations of residency, and for that matter of figuring out what's considered California sourced income? Well, there's many, and that's a whole nother discussion of itself, but I just want to talk on a few key ones, and a really good rule of thumb is how many days did you spend inside California and outside of California in a given year? In general, if you spend more than 183 days in one state, it doesn't have to be consecutively, that's going to determine your state of residency. And so this is a generalization, and I feel like a politician because everything I say has these little qualifiers. I feel like I have asterisks all over everything I say, which just means it depends and in general. But just about every single state has its own ideas of how local taxation should work. So it gives me a job, which is great. But anyways, the 183-day rule is a really good rule of thumb to kind of use. And now some other factors that are considered is, where is your primary residence located? Is it in California or is it elsewhere? Do you have any other real estate in California? Do you own a business in California? Or a big one is, if you have a business that's outside of California, but your customers are inside California, that can be a huge factor. where do you have your driver's license? What address is on there? Is it a California driver's license or a Nevada license? What address do you have on your US passport? Where's your car registered? Those are common ways that, can help determine your residency. And then if, the dollars are big enough, there's some other really interesting factors that can get used in residency audits, as they're called. And California is pretty aggressive in this, but they'll look at things like, where's the predominance of your credit card transactions originating? Where do you go to church? Where's your pet groom? Where's your circle of friends located? And where are you making phone calls? And I'm not saying that's going to always come up, but the takeaway on that is that if those are the factors that California and other states use in determining residency, then those should be factors you should focus on to kind of bulletproof yourself down and figuring out that clean break from the state. So now let's just say you've made that decision, you want to leave California, you've got awesome professional help, and you've done all the right things, and you've made that clean cut from the state. So what's going to happen, just kind of as a big picture, in the year you're making your residency change, you're doubtful you're going to do it at midnight on New Year's Eve. You're going to be out partying. So it's going to happen, during the year. So you're going to have a situation where you're going to have a part year return in California and a part year return in your new home state. And what'll happen in that first year is your income is going to need to be allocated between the two states. And in general, then the home state is most likely going to tax all of your income, but any taxes you pay on income in California will then become a credit on your new home state so that you're not taxed twice. Our tax code's a little goofy, but sometimes it's actually kind of fair. And this is one of those situations. But the key on that, though, is finding someone, a CPA or some tax professional, because they can figure all that stuff out for you. Next slide, please. Thank you. And, just some last little thoughts and conclusions. One thing to keep in mind is because, home prices in California are so high, if you sell your house in California, that can sometimes lead to a situation where you get to the new state, you realize you hate it and you want to come back. Sometimes you might find yourself in a situation where you've been priced out and you can't come back. So that's just something you want to keep in mind. But then other things you want to take into consideration, has been mentioned before, is the cost of living, local salaries, and things like that, because that's a huge factor. And one interesting thing that's come up with COVID is a lot of folks, who could work remotely figured out, oh, cool, I can, go to a much lower cost of living area and therefore have my same salary and a lower cost of living area and effectively get a raise. Companies figured that out and are starting to adjust people's salaries for the cost of living. So that's a nasty little surprise. But anyway, covered a lot of ground in a really short time. So if you have any questions, feel free, give me a call, send me an email, or anyone else on this panel. We're all here to help. And now I'm going to hand off the presentation to Darrell, who's going to talk about some financing options. And he's going to give you some really great real life examples. So take it away.
Thank you so much, Chris. Yeah, there certainly are a lot of important tax implications when considering moving out of state, as you can clearly see. My name again is Darrell Nelson with Diversified Capital Funding. And it's hard nowadays not to talk mortgages without talking interest rates. And of course, we've certainly seen an increase in rates as a result of inflation and consideration by the Federal Reserve. However, please keep in mind that even though we've seen an increase in rates, historically, rates are still quite low. Our parent company is a company called American Pacific Mortgage. And in terms of out-of-state lending, we lend in every state except New York. And one thing to consider is if you've owned a home for some time in the Bay Area, odds are that you have a significant amount of equity in your home. And yes, with the examples that Lisa shared, you can certainly have the option of potentially paying cash for a property. And you may consider that, or you may elect to hold some of that money back because even though rates have gone up and maybe we're in that low to mid 4% range, there are lower cost options, which we're going to look at in examples. But if you're looking at a 4.5% rate on your mortgage, consider the fact that somebody like Martin might very well be able to provide you with a lot higher rate of return which makes a lot more sense to go ahead and maybe have a mortgage as a result as well. So what I thought would be kind of useful would be utilizing a couple of the examples that Lisa shared, and just go ahead and maybe look at what some of the payment examples are. So the first one we're going to look at, as Lisa mentioned, was Eagle, Idaho. And in this example, as she mentioned, the average sales price is a little bit higher there, but certainly kind of a bargain by Bay Area standards. We're looking at an example of a sales price of $1 million. And regardless of how much money you get in net proceeds, perhaps a very large amount, right, by selling your house here in the Bay Area, we're going to assume that you're still looking at a loan amount of about $600,000. And utilizing a rate of 3.75%, you see that the mortgage payment's about $27.78 per month. As most people that own homes, you're going to be responsible for providing the homeowner's insurance. And we're just going to use an estimate of about $150 a month. And when it comes to property taxes, Lisa mentioned it as well as Chris. And just keep in mind that the state, regardless of which state, always has to generate their revenue in some fashion, okay? And the big three that they utilize, as Chris mentioned, are property taxes, state taxes, and sales taxes as well. And fortunately in Idaho, that tax rate is relatively low. And this is a real world example for somebody that's actually in contract right now. And the property taxes, by comparison to the Bay Area, is certainly quite low. This is about 0.71% property tax factor, which works out to be about $583 a month. So total payment with taxes and insurances is about $3,512. In the next example, we look at Dallas, Texas, and we're going to look like the same sales price and loan amount. Again, this is somebody else that's in contract right now for just a hair above $1 million. And so it's basically same loan amount, same rate, same insurance, but really to kind of point out the difference when it comes to property taxes is that the property taxes are higher, as Lisa mentioned, for Dallas. And this represents a tax rate of about 1.93%. Again, remember there are offsets, right? Maybe, no state tax, maybe different sales tax. So, we always want to look at that kind of as a whole. But however, that total payment is about a little over $4,500 a month, and that's about $1,000 higher than our example for Idaho. So, there's a lot of important things to consider. These are just more traditional examples. We do have a lot of people, I think Lisa mentioned it as well, where, maybe sometimes people find themselves in a situation where, they've found a property that they like, but they still own their existing home. We have loan programs that actually allow you to buy your house, your new home, before you sell your existing one. Another thing that's become common, especially if you find yourself maybe purchasing a house in that lower price range, a lot of people are actually buying these homes as rental properties with the intent of buying them, maybe lock in still a relatively low rate, and maybe with the hope of just converting that to their primary residence maybe a couple of years down the line. So there's multiple options to consider. At this point, I'm going to go ahead and turn it over to Rick, who's going to go ahead and discuss lifestyle loans for people over 62. Rick? Thanks,
Darrell. Good information. Darrell, you've been doing this for a long time. I know you know this stuff inside and out, probably off the top of your head. So my loans are a little bit different in that they are for people that are a little bit older. Okay. So the example I'm going to show you right here is generally you are 62 years of age or older. And the nice thing about this product is this is a product where the bank is required to be patient. Okay. What does that mean? That means that you get loaned the money, but you don't have to make the monthly payment. Okay. So what ends up happening is you buy the house. In this particular case, you might have a house for say 1.5. And if you're 62, your down payment would be about $781,000. If you are 70, probably about 700,000. So you can see it's around 50-ish% down. And then the bank is required to be patient on the rest of it. So you will accrue interest on that, and you'll see it on your monthly statement about what your tab would be if you sold your house at that time. The rest of the equity belongs to you, and the house is still titled in your name, but you don't have to make that monthly mortgage payment. So for instance, if you wanted to buy $1 million house, okay, or maybe not 1.5, but just $1 million, your down payment would probably be about say 500,000-ish, depending on how old you are, okay? So some people want to retire without a monthly mortgage payment, because when you do retire, it's all about cash flow. And so cash flow is king, as Martin and some of the financial planners will tell you, that's really important. Another thing that's really nice about this product is, Francesca, we can go to the next slide, is that now we have a new opportunity. And this one actually opens up the age group and the price range. We can go all the way down to 55-year-old buyers, which I haven't reflected in this matrix yet. I need to update that, but you can go down to 55 and still be able to take advantage of this product. So in this particular case, if you wanted a $2 million house at 62, you're probably putting down $1,040,000. If you're 70, you're probably putting down 930. Obviously, if you're 55, you'll probably put down a little bit more. But again, no monthly mortgage payment. There you have your cash flow. So the rest of your money can be working for you, and then you know that what your needs will be on a month-to-month cash flow basis will be less, because you don't have that monthly mortgage payment. You still do have to pay your property taxes and your homeowner's insurance, and you have to keep the house in habitable condition, and it must be your primary residence. But as long as you do that, this is definitely an option on a purchase basis as well. So it really doesn't matter what house you're selling or how much you owed on that house. All that really matters is what you're going to put into your new house and how the purchase will look. So hopefully that makes sense. Again, if you guys have questions, feel free to give us a call. Darrell's an expert on what he does, and I'm an expert on this lifestyle loan, and Martin and Christopher are experts, as Lisa knows where you should live. All right, Lisa?
Exactly. Well, that's great. I know I've had so many, families, buyers, use both of you for different purposes for their loans, for strategic, keep some money in their pocket so that they have more, availability for, their life. And then, like you said, Rick, you don't have a payment, and or Darrell, some people are still employed when they're retiring, they're moving, they own a business here. So, I have 2 clients right now that are moving out of the area. They're still going to retain their business here. So they still have the need or the want to have interest to be able to deduct, but they want to take some of that cash and go do something else with it. So it's an opportunity.
Yeah, and you can definitely still do that with either product.
Yeah.
Right. And it's
Love that.
depends on your situation.
Yeah. Well, and what we'll do is we'll open it up to questions. I know we've got some questions that people have sent in or are sending in now. So go ahead, and Francesca, fire away as far as questions. We want to help everybody out with their planning and all of their strategy.
Okay. So Victor from Concord is asking, if I live in another state 100% of the time, but I have a business in California, will that still mean I have to pay taxes in California?
Sorry, I was on mute. Yeah, so if you have a business in California that is generating, income within California, such as you have customers within the state, you're transacting within California, then yeah, it's going to be considered California source income. So that's a common one where people will leave, they'll go to Idaho, for example, and buy a home there, but their business is still in California, or a rental property is still in California. That's still considered California sourced income.
Yeah. Well, and the mistake that I've had a few clients make before they didn't ask before they did this, is they go off and buy a property in Nevada. So they're going to buy a home in Reno, and they're going to say, this is my primary residence. And therefore I'm going to try to avoid the state tax, but their business is here. And I'm like, well, you can't really get away with that. So talk to your CPA.
California caught on to that a long time ago.
Exactly. There's more strategy for that for sure. You can't just own a rental there.
Can't tell the Nevada property line there.
Exactly. Someone typed in a question too, Francesca, in the chat. So I don't know if you want to read that.
So Rick is asking, and this is for you, Lisa, regarding the sale of a home in California. If you bought a home for $1 million and sold it for $2.5 to $3 million, how do you figure out the capital gains taxes?
Okay, so this would also be a Chris question. I can give
Hey, Lisa, I'm happy.
Yeah, I'll give you the overview, and then I'm gonna let Chris correct me if I need. So basically it's pretty simple. California, if you're married, you have a deduction of 500,000. So you're going to take what you paid for your home, which is $1 million. If you're married, you're going to get that 500 bump. So now you're up to 1.5. And then you can deduct any improvements, any cost of sale. So I always tell people, and I'll ask you, Chris, if this is correct advice to give. People are like, oh my gosh, I've been here 20 years. I don't have all my receipts. I think that the IRS allows you to give an estimate. Is that right? Like a good close estimate?
Yeah, I've had a few cases where it was actually looked at and audited because the gain was pretty big.
Yeah.
And they had lived there for, gosh, 40 years. And what I did, this was the fun part. I said, hey, go get your family albums, go take a look at your house over the years,
Oh, smart.
And I said, look, find some pictures of your kitchen, your living room, show that, okay, we've redone the kitchen. And then, we just kind of went backwards and we just kind of figured out reasonable costs, and the auditor totally bought off on it. And so that was a win, in my opinion.
Yeah. You don't have to have, what I always tell my clients is, if you're reasonable, I think the IRS might look at it and accept. If you bought your house for, let's say, 500,000 and you tell them that you've had 800,000 in improvements, that might be a little red flag where you're not going to necessarily get away with. But so to answer your question, it's going to be your purchase price, your 500,000 if you're married, all of your improvements, plus all of your costs of sale. So keep that in mind, all of your closing costs, all of your anything that you had to do in order to make the move to sell the property, you would deduct that. And then the rest of that, you're going to have capital gain tax on. And Chris, what is the capital gain tax right now? What's the percent? I mean, I know it depends on the person.
Generally, it's around 20-ish%
Okay.
for federal. Yeah, California doesn't have a capital gains rate. It's just whatever bracket you're in, that's the rate.
Right.
So it's anywhere from up to like 13-14% is the max.
Exactly.
But putting my CPA hat on, I'm supposed to tell you have to keep 100% of your receipts for everything, blah 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 blah. And I understand life gets in the way and reality sets in, especially when it's 10, 20, 30 years ago. So yeah, but ideally, yes, you would like to keep your receipts.
Yeah. Save them, but if you don't, then estimate.
And then also on that $500,000 gain exclusion, just keep in mind, it's $250,000 per person. So if it's, a married couple, yes, it's 500,000, and it needs to be 2 out of the last 5 years. Doesn't have to be concurrent, and it doesn't have to be years. It's really months actually. And so if the property had been used as a rental at any point in time, that causes a little bit of a hiccup. And if you had a home office, that also can cause a little bit of a hiccup. So those are things to keep in mind.
Only if you wrote off that home office, right?
Exactly.
Yeah, it actually isn't considered part of your primary residence. It gets carved out.
Right.
Yeah, exactly. But yeah, make sure that's such a good point, Chris. Make sure that you're the years. And I have a lot of clients who say, okay, so hey, I'm going to move off to Florida or wherever for a couple of years. And then I'm going to want to sell my home. And I always tell people, be really mindful of that. Make sure you plan, because that 2 to 3 year window will fly by pretty fast. And it's pretty soon you are not living in that house 2 out of 5 years, and you've lost your deduction for either 250 or your 500. So be mindful of planning. And you never know what the market conditions are going to be like at that time. It may take longer than that little period of time to sell. So you want to give yourself time.
Right.
Make sure you've stayed.
Yeah. I think the other fun part, and that's where I earn my bacon, so to speak, is to figure out, okay, cool. You have, you're going to be selling your home. You're going to be having this capital gain. Well, do you have any other losses, any other capital losses? So this is where Martin can come into play is, are there any positions, dogs in your portfolio that you need to get rid of? And you can time it, and you can take the losses against the gains and maybe even make it tax neutral. And that's where doing the pre-planning can really pay off. Not after the fact of, oh, hey, I sold my house last year. How can you save me taxes? I can't do a whole lot there.
Exactly. A lot of people I'm sorry. Go ahead, Martin.
Oh, I was just going to say, if someone does have excess capital gains, that's well above the exclusion amount, the spousal exclusion, there are some tools in the toolbox that we have in the charitable area to get some offsetting deductions. You can kind of do well by doing good, but there are some charitable strategies we can bring to the table as well. I just want to throw that out.
Yeah, absolutely.
Well, I also tell a lot of clients that are planning, they're planning their retirement a few years down the road, but they want to go figure out where they want to move now. So I always ask you, do you own a rental property? Because you could take your rental property that you own, you could sell it wherever it is across the country, go do what's called a 1031 exchange. And if you have questions about that, let me know later. But you can transfer that investment property into the state where you'd really like to retire, buy a rental, and then eventually you can move into that property. And then at least as long as the tax laws don't change, you're going to recapture that as your primary residence, and you can defer some taxes with some strategy as well. So it'll allow you to do what you want to do, buy a property, and then talk about taxes later. So
Different ways we can move the chess pieces around the board, right?
exactly. As long as they don't take away our 1031 exchange, which hopefully they won't. I know it's on the cutting block as a lot of other things are,
Sure.
unfortunately. We'll do an update with you at the end of the year, Chris, if anything crystallizes, all
Oh, I can't wait.
the fear.
And another thing to kind of tack on with what Lisa just said, for those of you that don't know what a 1031 exchange is, I'll just say real quick, and so it's a way of, if you have an investment property, you can sell it and buy another like type property, whether you have a rental, you could then buy yet another rental, or you could, it just needs to be the same. It doesn't have to be like, I have an apartment building and I'm buying another apartment building,
Right.
but it could be, you sell an apartment building and you buy a piece of land, it just needs to be of the like kind. And well, anyways, if you follow the rules and do all the things that need to happen, which I won't explain, you can defer that gain. And so, if you have $1 million, gain in this property you're selling, or 500,000 or whatever, you can then kick the can down the road and put that gain into your new property that you buy as part of this 1031 exchange. And one little caveat to that is, California caught on to this too, is, okay, cool, I'm going to defer this gain in California. I'm going to go buy in Texas or Florida or wherever. There's a form you have to file in California every single year, as long as you hold that property, to tell California and put them on notice, hey, I've got this California gain that I'm not paying you. Don't forget. So just keep that in mind.
Exactly. There's another question for you, Chris. I think it's from that same person who had asked Rick Bindi, who had asked a question. He said, if it's not a rental and not a home office, so it's around 20% for federal and 10% for your state, question mark.
Yeah.
Is that, yeah.
Yeah, I mean, it all comes down to facts and circumstances. You can have other things going on, but that's, I'd say 30-40%. That's kind of a good, just to kind of put your thumb out there and just put some numbers down, and kind of a pre-planning, sense. But what it really all comes down to is, once you put all the numbers down, and because all your income is just going to go into a bucket, and it's not, the tax on this is that, it's all my income goes in here, all my deductions go in here, and what shakes out the other end, we then compute the tax.
So there was another question, if you could be a resident of both states at the same time.
You could be a part-year resident of both. Is kind of a way of looking at it.
Okay. And then there was another question, Lisa, it looked like they were asking about Minden, Nevada.
Yeah, they said they wanted more information on Minden, Nevada.
Okay.
Yeah, I am Minden, Nevada. Actually, I used to live in Reno back in the day. I started my real estate practice back in the 80s in Reno. So I know that Minden area well. It's in between like Carson City and Reno. And it's wonderful retirement communities. There's 55 and older. I've had many clients that have moved there. Whoever the question is, what I'll do is I'll reach out to you and I can answer questions, but pricing is affordable. It's gone up just like everywhere else, but it's way more affordable than the Reno market. And it's a beautiful, serene, little quiet little town called Minden, and the town next to it's called Gardnerville. So the two areas together are beautiful, super good. And you know what I love about that area? I recommend a lot of clients consider there, because they have family here in the Bay Area. They don't want to be too far. You're 3.5 hours away from your family, rather than necessarily moving to another state, where you have to fly to visit. So, Nevada's a good possibility, good that Reno area.
Found out that the flight from Oakland to Reno is very short. It's very easy.
Yeah,
Yeah,
super.
that's a pretty nice little quick jaunt up there, rather than the 3-hour drive.
Yeah, for sure. We used to go back and forth like all the time driving, but yeah, you can fly. Yeah. So Francesca, I think you've got some more questions as well.
I do. David has a question about lifestyle loans. He said, do you offer fully underwritten pre-approval?
Yes, actually we do. So it's not a pre-qual or anything less than that, where, it's actually gone through the process. The underwriters looked at it. The underwriter says this is a good deal, assuming you still get the down payment necessary. This loan will go through. So that's really helpful for your realtor, so that when you go shopping and you're competing with other people, if the realtor is smart, they will explain that with this lifestyle loan, you're putting in a really big down payment and you're pre-approved. So that helps a lot. Yes.
Yeah. You're competitive.
Mm-hmm.
I know Darrell too, I wanted to share, because Darrell's helped the other clients of ours that are moving out of state where they can buy first. Darrell, you have that loan where they can buy first. I had a client ask me the other day, how long do they have to keep that loan? Because once they sell their house, they might want to pay it or pay a lot of it. How long do they have to keep it in place when they do that?
Or do you mean the loan that they're getting initially, correct?
Exactly, or like where they're going ahead and qualifying by
Right.
taking money, like it's almost like a bridge loan, but it's better than a bridge, right? It's like,
Yeah, exactly. Well, it depends on program. One of the things actually that's actually a great point, Lisa, is that when people find themselves buying that house before they sell their existing one, sometimes people think they have to refinance because they have this lump sum that they're going to receive and then thus pay their balance down. But what a lot of lenders have switched to, which a lot of people are like, because usually purchase rates usually are a little bit better than refinance rates, is that, let's say, for example, somebody ends up and buys with a $600,000 loan, like in our example, yet they're going to, when they sell their existing home, let's say they have like $400,000 in equity. Well, what a lot of lenders offer now is what's called a recasting feature. And what that essentially means is, let's say once they have that $400,000 from proceeds, they pay their $600,000 balance down to a loan amount of $200,000, and generally for like a nominal fee, maybe like $250, the lender will recalculate the loan for the remaining life of the loan at that new balance, thus lowering the payment, and they ultimately end up with the same loan amount that they would have had if they'd actually sold their house first.
Wow.
That's usually kind of the best option available when buying before they sell their existing home.
That's cool.
yeah, there's so much, things have come back. You know, I remember back in 08, 09, we lost some of our features in our loans to be more creative. And now the little bit of creativity has come back,
Yeah.
fortunately. So we can do things a little bit outside.
Hopefully not too much. You know, they got
No,
creative in the early 2000s there. So
we do not want creativity.
I think-
like that.
I think all our businesses, there's a lot more underwriting on there. That, you know,
without a doubt,
because
without a doubt.
you can't let happen what happened before, right?
No.
Oh, gosh,
Not at
no.
all.
Yeah, we had clients that were buying houses at 110% financed, right? It's just not okay. So yes, I'm so
Yes.
glad that they're not doing that.
I think I was shocked when I went out front and my gardener told me he's lost 2 houses already. I'm like, how do you have 5 houses to lose to? I'm doing something wrong.
Yeah, they were offering loans without much qualifying and things. And so
Yeah.
we're glad that that has changed for sure.
Yes.
Yeah, we want, yeah. So any other questions for us, Ms. Francesca?
Yeah, so someone is asking, how can I reduce my taxes on the sale of my rental property I purchased many years ago with a low tax basis?
Well, you could die. That's probably the best way to reduce and eliminate your tax, but that's probably not a good option, because you would get what's called a step up. So the property would then be revalued at the fair market value at the time of passing. I just say that tongue in cheek, but that is something, you know, that if, you know, a family member, you know, and you're the beneficiary of someone's estate and you inherit a property, you would enjoy typically that benefit of the step up. But for you, you know, as the owner of the property, you know, Lisa mentioned the 1031 exchange. So if you're selling a property because you know, maybe the area is changing or you want to leave the state, like, you know, Lisa was mentioning, you could do the 1031 exchange and defer that gain and kick it down the road. And if you have a family, you know, with kids and that kind of thing, hang on to that property. And then when you pass away, they would then inherit that property and get that stepped up basis. Granted, you know, if there's no tax law changes that take it away, but they would then get that stepped up tax basis and they could sell it the next day after you die and pay zero income tax, you know. So that's a strategy. I mean, that's where a whole planning thing can come around, but you know, all the costs that you spend on improving the property over the years, those are all things that add up to the basis to get it up higher. But there really isn't any magical thing that makes basis appear. Martin and Liz, you have some ideas. You know, there's other strategies out there on ways that you could try to mitigate or defer gain, things like opportunity zones. You know, so there are some strategies out there that you can take advantage of, and that's where sitting down with someone and talking about all those and seeing where you're at, and just kind of working through it. Because sometimes people get so, you know, caught up on taxes, they get so, you know, freaked out about it that once you start putting numbers down on paper and just kind of just getting it all mapped out, it's then not this scary thing anymore. And it's a little more manageable.
I just add to that, Chris, the 1031 exchange can be a really big tool in the toolbox that we use, especially in your retirement years when you probably don't want to be a property manager.
Right.
And deal with tenants and things like that. We actually have some programs where you can do a 1031 exchange into something called a Delaware Statutory Trust, which is a pool of properties.
Right.
You can actually have geographic diversification of your real estate investments. So you could have properties in multiple states, and most of these are triple net lease, so you don't have any obligation to pay taxes or insurance or maintenance on the properties. You just sit back and get a check mailed to you or direct deposited to you in your retirement years. And when those programs mature, they basically, you can roll that into another 1031 and do the same thing, collect the same income stream. And if you, like Chris says, if you keep rolling these 1031s, just exchanging, we call it swapping until you drop, swap until you drop, and you never actually will have to pay the capital gains tax on the property if you do that. Another one, a little more creative, perhaps, is I mentioned it earlier, some of the charitable strategies. If it is an income property and if there's no debt on it, if there's debt on the property, it makes it more difficult. But if it's a free and clear income property or commercial property or business, you can even do this with low basis stock. If you have that Google or Apple stock you bought years ago, you can actually do something called a charitable remainder trust, where you actually create a charitable trust. You can be the trustee of it. You can transfer the asset, the property, the stock, whatever it is, prior to the transaction, liquidity event, have the trust sell it and incur no capital gains tax. And you can reinvest 100% of the proceeds into a portfolio that generates income. And that can be lifetime income. Anyway, that's a little more sophisticated strategy, primarily used by more high net worth people, but that is another option.
Yes. Well, I think it's wise for people to, people of all like cycles in their life, whether they're young and they're just starting out with their growing their net worth and their real estate investments, or someone who's getting ready to retire, and meeting with someone like you, Martin, to really pencil out the whole plan, because we have to take so much into consideration. You have to take into consideration your, funding your own retirement, then potentially funding, like a lot of us had kids when we were older, funding their, colleges and graduate schools and just all of it. So the planning with you is such a critical piece. I know we were talking about the other day about, long-term care and just things like that.
Yeah, we have the,
into our retirement.
unfortunately, they call it the sandwich generation. You have older parents that have a lot of healthcare expenses, long-term care, and you have kids, you got to pay for their college and go sign on their student loans and all this kind of stuff. You're getting hit both ways, right?
Yeah, we were in that situation. Yeah, Greg and I were in that situation for a number of years where, elderly parents and teenagers moving into college age years. It's like, but the planning, everyone should talk about putting their home in a trust. Everyone should talk about, meeting with an estate attorney and someone like Martin to help you plan and all that. So super important.
Well, I'll just, put this out there is, I meet a lot of folks all the time. And the most common thing I find when I meet with someone for the first time, I'll ask, do you have a will? And I'd say 90% of the people I ask say no, or they did it 10 years ago or 20 years ago. And especially if you have a family, make a phone call today to an estate planning attorney and get your will drafted up or updated, because I'm guilty too. I was about a year into my second child's life when I woke up one morning in a panic, realizing I hadn't updated my will. So it happens. I get it.
That's very good advice. A living trust is very important for many reasons. I mean, what if you get hit by a truck and you lose capacity tomorrow, right? You're not protected. You don't want to put your kids on title because they could get in a car accident and get sued and you lose your house, right? There's all kinds of reasons why that makes a lot of sense. And maybe someday, Lisa, we need to include one of those estate attorneys into this group here too.
Yeah, I was just thinking that's a good idea.
Yeah, and in addition to the lack of will, in a more basic level, just I can't tell you how many times I've told people to check their beneficiary designations on their life insurance and their 401k plan and their IRA, and it's It's the old spouse they divorced 10 years ago. So that's
Yeah.
another one. Update
Hey,
your
Lisa,
benefits.
somebody wants to know, they just saw an anonymous attendee say, how do we contact speakers if we have more questions?
Very
Okay.
good question. So what we'll do is we're going to mail out, email out the playback of all the people that registered. And then we'll also give them all of our contacts because we're all here to answer questions. Now, I got a lot of questions right now of what is my house worth? You know, what is it really worth? And that way people can make more plans. You know, they can kind of set their plans in motion. Most people are very naive to how much their homes are really worth. You know, they're shocked to know. Some pay close attention and others are a little bit less aware. So you want to know. But yeah, we'll give all of our information. That's such a good question. Whoever asked that, you know, thank you.
Do you want me
Um,
to share it really quick on the screen?
That would be awesome. And thank you
Yeah.
everyone for joining us. You know, we so hope that we help to answer some of your questions that you're having, and we hope we can be a resource for information as you continue your planning. You know, feel free to call any of us, and we're so honored to help.
Yeah, thank you, everyone.
Yeah, thanks.
Thank
for
you,
joining.
guys. Thanks for
Take care.
coming.
Stay well.